It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners on the program. With me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
If your income is above certain thresholds leading up to retirement or even in retirement, you may be required to pay a higher amount for your Medicare Parts B and D. So how does this extra charge work? And more importantly, what financial planning work can you do to avoid its impact in your financial life? That and more coming up on this hour of Wise Money.
Are you mad yet? I don't like it. Just almost doesn't seem fair, and that you can't use that term, especially when you're talking about this. Life's not fair, and this feels not fair. And anyway, we're going to help you with this and plan through it and avoid as much as possible these potential surcharges. If you have any questions for the program or need any help, gosh, we are here to help you, serve you. You can call or text 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com, and then all over social media. Wherever you're at, we are there as well. Search The Wise Money Show. Okay, so the transition onto Medicare, gosh, you want it to be simple, and it is anything but. It is confusing, and so hopefully you're working with a CFP, and they are doing comprehensive financial planning, working and collaborating with your CPA and with your health insurance expert, and they're coordinating all of this because your tax picture impacts what you pay for Medicare, and that might impact your decisions when you should get on Medicare, all that sort of stuff. So let's first just level the playing field. What are we talking about? It's an acronym called IRMAA. What is it? How's it work?
Well, it's a way that the government essentially does means testing for the amount that you will pay for your Medicare Part B or Part D premiums when you get into retirement. And, you know, if you're not to retirement yet and you haven't started educating yourself on this, let me tell you, there's a whole lineup of people that would love to educate you on this, and you will start getting stuff in the mail as you get closer to age 65. But it's something that for most people it applies when you get into retirement. At age 65, you come off of your group health insurance plan, or maybe you've had your own private insurance covering health care for you throughout your working career. But you go on to this government plan, and there's different parts to it. Part A, which is what covers your hospital coverage, it's a no premium cost to most people.
Assuming you've just paid it all along, actually,
right,
through your Medicare
If
taxes.
you've been paying in for at least 10 years, then you qualify to get that coverage just provided to you. But Part B, which covers the doctors and all the medical procedures and things like that, that coverage costs you something. On a monthly basis, most people are going to pay $170 per month, and that's per person, so each spouse is paying that, unless your income goes too high. Yeah. And then the government starts tacking on some, I think of them as penalties. I don't know how you refer to them, but it's essentially like an extra tax or an extra cost that drives. It doesn't improve your coverage. It doesn't change that you're suddenly into a better plan or anything like that. No, Part B is the same for everybody, but not everybody pays the same.
So that rate is, I'm just going to tell you right now, it will definitely be going up in 2023. That's the 2022 number, the $170.10. If your income is above $182,000 married filing jointly, then you've got to pay this extra amount, this IRMAA amount, okay? $91,000 if you're single or married filing separate return. But then, so it would go from $170.10, that first tier. If your income, we'll just talk married filing jointly, is between $182 and $228. So not a huge range there. The cost goes from $170 up to $238.
Yeah, that's $68 more per month to get the same thing that you would have gotten at $170 per month.
But here's the thing: you might say, "Well, that's not even that big of an increase." Okay, I can deal with that, you know. But if your income is between $228 and $284, then it increases even more, $340 instead of, it basically double. You're paying double, and it continues to ratchet up from there. So here's the thing. This is why, we've talked about this before. We've warned you of IRMAA, but I was serving some folks recently who as they were getting ready for retirement, they sold a property one year, sold another property the next year, and then there were some other transactions that were going on that just caused their income to be unusually high as they were preparing for retirement. We were well aware of Irma, and yet now that it's a reality, it was very frustrating. Like they're disappointed, frustrated, because also all of this income created a lot of tax. So they're saying, gosh, we're paying all this tax and we're having to pay more from our Medicare. And why is that? Why is it especially frustrating? Because it's the income from 2 years ago. Right now, they're saying we don't have that income, and yet you're forcing us to pay more on our Medicare right now. That's the prior year rule. Josh, can you explain that?
Yeah, I mean, most of the time we're looking back 1 year, what happened in last year's tax return. But on this particular rule, they look back 2 years. And if your income was over the thresholds at that time, then unfortunately you're going to get hit with this penalty for an entire year.
And that was basically the first question these folks asked is, can you verify this? This is what they're saying our income was. I don't believe it. Can you verify? Or send me the tax return and I'll verify. And it's like, yeah, that's spot on. I mean, to the dollar, that's correct.
Right.
So you just don't think of it because it happened a while ago.
There are some times, I can remember some stories of specific clients where they had an anomaly of some sort in their income. It was a one-time deal. Maybe they sold a business or sold the family farm or something that caused their income to spike temporarily. It really was only going to be 1 year. And then they were going to drop back down to a normal level well within the income limits for Medicare Part B and Part D. And there is a way that you can file an appeal. We've gotten some of those to be accepted, and sometimes they get rejected, and it doesn't seem like there's any method to the madness sometimes.
I've essentially seen the same scenario, both get approved for being exempt from this, and others where they have to pay it for the same scenario.
Yeah. Yeah. You have to try, though, right?
Yeah.
It's a significant cost, especially because some of those events, they don't send you just from, the normal tier up into the second tier. It doesn't take a lot of extra income to throw you all the way up, right? Especially a big transaction. And then it can be, hundreds of dollars per month per spouse for the entire year.
I do want to throw up by that. Yes, Kevin.
Yeah, I mean, so there are 7 qualifying life-changing events. So there is some method to the madness, and I've seen that as well, where folks the prior year had huge income, and they're sitting here today saying, "Look, we're on a fixed income, we don't have this ridiculous thing." So I mean, death of a spouse, marriage, divorce, work reduction, work stoppage, loss of income from an income-producing property, or reduction of certain kinds of pension income. So there are a number of things, but this is a stealth tax, if you will, because it sneaks in, and we'll probably be getting into that, like some scenarios where folks are going along in retirement and everything is fine, and then there's a financial decision that happens in a year, and you don't realize it until 2 years later, where you get the letter and you're like, oh, I have to pay more?
Yeah. Well, to add a little bit of insult to injury here, it's not just your Medicare Part B premiums that can be affected here. It's also your Part D, which is your prescription drug plan as well. And you pay your premiums to the drug plan, and then you pay an extra penalty to Medicare on top of that if Irma catches you.
Wildly frustrating, as we've already shared. And you can understand this and you can be aware of it, but then when it actually happens, it is terribly frustrating. So here's the thing. How can you avoid it? How can you eliminate it? How can you avoid it? What are some steps that you can take to plan ahead and avoid Irma? We're going to help you with that and more coming up on The Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is The Wise Money Show. You're at The Wise Money Show channel. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time, also on podcast as well, same time, also on a couple local radio stations as well, and which is why the content is as long as it is and structured the way that it is. If you're looking for more content or maybe briefer content, shorter content. Good luck, or good news, not good luck. Good
We're
news.
incapable of shorter
That's right.
content.
That's right. No, but you are in the right place. We've got Next Wise Step videos that air all throughout the work week, 10 minutes, 8 minutes, something like that, taking one financial concept, applying it directly to your financial life. Have done lots of content about how to plan around IRMA and help avoid it. And so make sure you hit that subscribe button, turn on notifications, and if you like the content, like the content. Thank you very much. Taking some boring stuff and trying to add a little personality and some humor and have fun with it. But
Well, I mean, the struggle is real because, and I'm assuming that we'll share this during the show, but I mean, I just had some clients that willingly and knowingly entered into IRMA territory this year. And it's, I don't think it registers. It won't fully register until 2 years from now. And then 2 years from now, they're going to be ticked.
yeah.
Was it because they just wanted to get some extra money out of some investments, or
sell
an asset, or?
Yeah, I mean, they're looking at their resources, which are basically all tax qualified, and saying, we're never going to get to all this money in our lifetime. And we have heirs who could use some money now. And so instead of having, one big fat check after the second funeral, we're going to start dishing it out today and see and actually even benefit from it a little bit. But in order to do that, they had to pull money out of their retirement plans.
Let's hit a couple briefly scenarios, and then we can get into, okay, what are some planning ways that you can avoid or limit IRMA. So, all right, here we go. What are the things that you can do right now that you can prepare ahead and avoid or eliminate IRMA, this surcharge, this nasty additional amount that you've got to pay for your Medicare Part B and Part D? How can you plan your way around it so you're not impacted by it? That's what we're helping you with right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFT studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast wherever you listen. Go check us out. Search the Wise Money Show, subscribe or follow us there, and then rate the program. We appreciate it. All right, so we're talking about IRMA, the income-related monthly adjustment amount. That's right. From 2 years prior, if your income's above certain thresholds, then you're going to pay more for your Medicare Part B and Part D, adding insult to injury. How do you plan around it? What decisions can you make today to help eliminate or limit the impact of IRMA? Before we get to that, what are some common scenarios, guys? We see collectively, 1,000 or so people a year. What are some scenarios where you've seen, IRMA just all of a sudden pop up?
Well, if someone says, hey, I'm going to do some planning, and I've got more than enough money than I'm going to use in my lifetime, and I want to start getting that money dished out to my heirs, and I just dealt with this situation where they're saying, hey, one of my beneficiaries needs some help, and it makes sense. The help makes sense. It's not enabling. It's not anything. Not that we don't judge, but you look and you say sometimes helping can hurt. So this helping is not hurting, but in order to do it, because these folks are in a position where all of the investment money they have, it has never had any taxes paid on it. And that's not an unusual situation. Most people, as they work their way through life, the money that they left invested and the money that they kept their hands off of was the money in their retirement plans. So that's the money that grew and grew and grew and grew. And so now if you're in your mid-70s, that some of that money has been growing for 40 plus years.
Yeah.
And so they have a lot of money in their retirement plans. That's the money they wanted to access. There was, in a perfect world, what you would do is you would split it over 2 years.
Yeah.
But if one of your beneficiaries has a time-sensitive thing, whether it's an educational thing or I want to send one of my kids to college or grandkids to college, or I want this beneficiary wants to buy a house and needs a down payment, fill in the blank. These things, they need the money. They can't say, hey, I'll take half the money now and half the money on January 1st.
Although that is, there's some planning around that scenario that you just described, where it's one of those situations where even in retirement, there are times when borrowing some money could help you do some tax planning. Get all the cash in your hand so you can do that task with the money right now, but then you pay it back, part of it now, part of it after January 1st or even the following year. And then you're just kind of spreading the tax pain out. And I think it's important. It's one of the reasons why before you make a major financial transaction or a major commitment in your financial life, to be talking to your certified financial planner, because there may be some unintended consequences like IRMA that we're talking about today, that it's not even on your radar. Because why would it be on your radar?
Yeah.
Like a normal person wouldn't be thinking about this. And but of course, your certified financial planner needs to be and may have some strategies to help you dodge this or stay under the threshold whenever possible. There are some people out there, though, that they're just blessed. They have been very financially successful. Maybe they've received some significant inheritance. And it's like structurally their income every single year is going to be up there flirting with IRMA anyway.
Yep.
And then anything that changes it from one year to the next, maybe causes a little bit more income because of your portfolio kicking off more dividends, or maybe there were some capital gains that get pushed through. Things that may be even completely out of your control can have you teetering on the edge or even jumping potentially into a higher bracket for IRMA.
Yeah, selling a property, selling a business, selling Apple stock when you thought it was high or something like that. All of that can land on your return and push it above those thresholds, creating some IRMA. So what are some ways that you can limit and plan ahead to avoid IRMA?
And I would just add to that one as well, Mike. Depending on how your investments are structured, there can be capital gains distributions that you weren't aware of or you weren't planning on that happened either throughout the year or at the end of the year. But it doesn't. It's very interesting how this stuff, it doesn't really register. And then, especially if you're working with someone and they're not bringing it to your attention, hey, understand all the ramifications of this. If we sell this, if we reallocate from mutual fund A to mutual fund B, there's going to be a gain here. And so this is going to...
Man, last year I had a client that we were doing some tax planning in the fall, trying to get their income. We were trying to realize the right amount of gains, and we even were looking at a Roth conversion. But all that creates extra income, and so we went up to within 10 grand of the threshold. We wanted a healthy amount of buffer there. And then the capital gains came in higher than expected, and we got within a couple grand. And I was sweating it at tax time, but thankfully we stayed under the threshold. I'm glad that we gave ourselves a big enough buffer there.
Another scenario that can push you into IRMA is your required minimum distribution, where you're going on and the early part of your retirement, you're drawing what you need to out of your IRA, or maybe not anything at all because you've got other resources. And then all of a sudden, you reach that magic age 72 and you're required to start pulling some dollars out, and that can push you above the threshold. And that's a good segue into how can you start to plan today to avoid or limit having IRMA impact you out there in the future. And we're going to hit 3 ways, a few more than that actually, but the first one is doing Roth conversions either early in retirement or even during your working career.
Mm-hmm. Well, this helps to avoid some of that scenario that Kevin was describing earlier, where if you get out to retirement and your entire nest egg is inside of IRAs or qualified accounts, as we often call them, they're tax shelters that you haven't been paying taxes along the way. When you pull the money out, it's treated as income and you pay your tax. Well, that extra income can, again, push you into a higher tax bracket, but also a higher IRMA bracket, where you're now paying these higher Medicare premiums, Medicare Part B premiums that we've been talking about here. So how do you avoid that? Well, it's not by under accumulating for retirement. Well, just don't get a big enough nest egg, right? No, have at least some of your nest egg diversified into Roth accounts where the Roth IRA, when you pull money out, it does not add to your income. It does not cause this IRMAA problem, but it's something you have to be planning ahead, right? You have to be doing these Roth conversions before it's time to be living off that money, and that way you can shrink down some of the size of that tax ticking time bomb, as we often call it.
One of our favorite strategies, if you've been preparing ahead of time and you're able to retire early, say 62-ish, doing Roth conversions at that time. You've got a couple of years where you can do some Roth conversions before it would be the prior year and impact your IRMAA and Medicare. I mean, it might just be 1 year, might be a couple of years, but even that alone, if you couple that with delaying Social Security and living off some other resources, you can make your income look really small, convert a decent chunk of your IRA into Roth over a couple of years, and then you're sort of smooth sailing potentially for the rest of for maybe even the rest of your life, either limiting your required minimum distribution or giving you more options when it comes time for, hey, we need an extra chunk of money to buy the new car or something like that. You've got options. What are some other ways that you can plan around IRMAA and eliminate it or limit it in your financial life? We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. Next one is just sort of a continuation on, but instead of Roth conversions, it's contribution. So we'll definitely hit this one. We'll hit tax loss harvesting and maybe even get into some of the other strategies, QCDs, that sort of stuff. So third segment.
So, yeah, we didn't really explain what a Roth conversion is.
Okay. Yeah, you want to?
Surely.
Okay. All right. Okay. The Roth IRA, your Roth 401k, is an instrumental vehicle when it comes to helping to avoid IRMAA. So the trick is, how can you get as much money growing in a Roth as possible? We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. My name's Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media, wherever you're at. We are there as well. So how can you limit the impact of IRMAA, the income-related monthly adjustment amount, the surcharge on Medicare, that if your income is above a certain threshold? Well, one way is just utilizing the Roth. We talked about doing Roth conversions early in retirement or maybe even at opportune times during your working career. Before we go on, Kevin, what's a Roth conversion? How does that work?
Yeah, so there's two ways to get money into a Roth IRA. And when you hear Roth, think after-tax money. So anything that goes into a Roth IRA is after tax. So I'm either contributing, writing a check out of my checkbook or however you get it in there, and I can do up to $6,000 or $7,000 if I'm 50 plus. So I can put $7,000 in there as a contribution on an annual basis, and again, that's limited based on your income. Or I can convert, so I can take money from a traditional IRA. So when you hear us say traditional IRA, think pre-tax money. Think money I've never paid any taxes on. So I take my pre-tax money, convert it over to my Roth IRA, and that Roth conversion, when it goes from traditional IRA to Roth IRA, that's a taxable event. So if I moved $50,000 from my traditional IRA to my Roth IRA that year, I'm going to get a 1099 and pay taxes on $50,000. So now that's a way to kind of turbocharge what's in my Roth IRA, because if I could only put $7,000 a year in, but I converted and put 50 in, now I've got more money, and that more money is going to be doing the compound interest effect, and so
without being taxed. All that growth never gets taxed in the future.
Right.
It's unbelievable. And it does create a huge pool, hopefully a big pool of money for you in retirement that you can tap into whenever you want to without paying any taxes along the way. And one of the other advantages is that Roth IRA doesn't carry with it a required minimum distribution. The government doesn't care about forcing you to take money out because they're not going to get any tax out of the deal anyway. They do want to force you, at age 72 to begin pulling money out of that traditional IRA. And for some people, if you've got significant income and other kind of permanently structured income that will always be there, these required minimum distributions might be big enough that it causes you to start jumping into this IRMA situation where Medicare Part B premiums get very expensive very quickly.
Withdrawals from your Roth IRA don't impact IRMA, but guys, what if it did? I mean, so really when we're talking about income, these income thresholds, that's modified adjusted gross income. And for most people, it's adjusted gross income. There's not a lot of modifications. But it wouldn't really surprise me, guys, if out there in the future the government passes a law that says Roth IRA distributions are going to be counted as part of your modified adjusted gross income, and now that's going to play into this. Right now, that's not the case, okay? I'm not trying to scare you away from it. I would plan based on the laws that we know, not the boogeyman, the what ifs. But it wouldn't surprise me.
But this is the case that you want to be playing chess, not checkers. You want to be thinking 3 moves ahead in the event that you can and you have resources that need to be planned for. Because I was just meeting with some folks yesterday, and we're looking at their tax projection for this year, and we said, hey, look, you can convert about $28,000 from IRA to Roth. And he said, well, okay, so listen, I want to pay as little taxes as I can. And I said, okay, well, just remember, you want to pay as little tax as you can over your lifetime, not in this current year, because all of this IRA money,
it's going to be taxed eventually.
It's going to go to your children, and they're likely going to still be working, and they'll only have 10 years to take it out. Mm-hmm. So all of a sudden, you look at $1 million IRA, and it goes to one beneficiary. That beneficiary has to take out $100,000 a year to layer on top. Now, they don't have to do it specifically that way. They could wait until year 10 and then maybe have it's grown to $2 million and take it out and pay taxes on $2 million instead of $1 million.
Yeah. It's interesting. But again, leverage Roth IRA, advantage Roth IRA. So Roth conversion is the first way to help manage and hopefully eliminate IRMA out there in the future. The second way is to just be funding that Roth 401k, funding that Roth IRA, maybe even funding that HSA and not spending it. Basically building up assets in accounts that will grow tax-free, that grow tax-deferred and be withdrawn tax-free out there in retirement.
Right, and so that's an interesting one because if you listen to this, and a lot of times with just a little bit of information, at least I find myself tempted to, you watch that infomercial for about 3 minutes, and you're like, I got to call, I got to get me one of those. So you're listening, you're like, okay, I got to do the Roth 401k. Well, do I have to do the Roth 401k? And this is, again, it needs to be part of your financial plan because some people, it makes sense to fund the Roth, either a Roth IRA or the Roth version in their 401k. Mm-hmm. And some people, they should be doing pre-tax in their 401k. Mm-hmm. And you say, well, which one should I do? And the answer is it depends.
That's right. But here's the philosophy behind the Roth. You believe that today you could pay a little bit of tax and avoid bigger taxes out in the future.
Yeah,
right?
that's it.
You think that you're in a lower tax bracket today, and out there in the future it would have been more tax paying. So you're trying to pay the tax while you're in the lowest possible tax bracket.
Not necessarily so. You have some people that say, I'm in a monstrous tax bracket right now, the worst one possible, and I'll always be there. So I'm going to just put the money in the Roth IRA because that's the only way I can get money into a Roth IRA.
Yeah, but I would argue that those people, they're always going to maybe be in the highest tax bracket, but the risk is that the bracket itself gets worse in the future, right? Because by historical standards, we've got fairly low tax rates today, but will it always be that way?
And plus,
I know, but dude, I've been doing this for 28 years, and everyone keeps saying, hey, the tax brackets are going up, and they could, but they haven't. They've gone down. Now, the interesting thing about the people that are in the top tax bracket, and you say, all right, well, then they should maybe consider doing the Roth. A number of those people that are in the top tax brackets are actually business owners, or they have some other source of income that makes their strategy, which we're going to get into, hey, that 401k money, do it all pre-tax, never pay a penny on it. And when you pull it out, let that be the money that you give to the charity. So no one ever pays tax on that money, and it goes to if one of your beneficiaries is a charity, and especially on an annual basis, hey, that's the money that you're going to be giving to the charity. And I have a number of clients where, hey, that's their strategy.
Yeah.
They don't want to be building up Roth money. They want to be doing pre-tax because it's going to the charity.
Yeah, got it.
Right.
Third scenario or third strategy, let's say, to avoid or manage IRMA, and this one is specific to right now, unfortunately, because of how the market's moved, but also, we were talking about certain scenarios that could push you into that IRMA territory and, selling a business, selling a property, selling an investment that maybe you've held for a long time or you received as a gift or inherited. You could have capital gains that all of a sudden land on your return. Josh's example where capital gain distributions landed on the return. Well, you might have, if that's the case, you've got assets growing outside of tax shelters. And some of those investments in those accounts may have had a rough year this year. And there may be an opportunity to do some tax loss harvesting, shift an investment from one thing to something else, and have a loss that offsets some of those gains to keep you below these income thresholds. So work with your CFP, do that proactive planning, see if that makes sense for you. All right, we've got more coming up on the Wise Money Show with Korhorn Financial Group. All right.
Okay, so did you skip QCDs?
It's in 4 segment, my man. You are.
I'm looking at.
He just did the bottom of page 2.
I did because we're
we're going in the 4 segment.
we're going in the 4 segment. So
Where was I?
I don't know. That's like the third time you're saying, I know we're talking about this, but let's talk about this too. And it's like, buddy, we got a certain amount of time on the. We're not gonna be able to say everything. Going back to our friend, that sounds like wood. We won't be able to say everything. But yes, 4 segment. I plan on hitting. QCDs.
My goal for this show was to say everything.
Say everything.
How close are you?
That was one of my.
Are you within 13 minutes?
That was. I remember that movie, Say Everything, with John Cusack in it.
Say anything.
Oh.
All right, my bad.
All right, so 4 segment. So yes, we'll.
Lindsay, you weren't old enough to be watching movies back then.
We'll hit QCDs and other strategies, and then talk about multi-year tax projections, all that. So yeah, we're not getting into listener questions. Next episode, we absolutely will. So, all right, here we go. Yeah, just okay. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on the YouTube channel. Go check it out. Go to YouTube, search the Wise Money Show, and subscribe to it there. Turn on notifications as well, because there's a lot more than just the talk show that airs on that channel. We've got lots of content that airs all throughout the work week, helping you take your next wise step in your financial life. So go to YouTube, search the Wise Money Show, subscribe to it there, turn on notifications, and if you like the content, leave questions as well. All right, we're still unpacking IRMA and how you can plan around it. We hit, doing Roth conversions and then also contributing to Roth 401k, Roth IRA. Basically, try to get as much money growing tax sheltered, tax free as possible. Right now, when the market gives you lemons, make some lemonade. If you've got capital gains, or maybe you don't even have capital gains, but you're right on that line. You're on your just normal income is getting you pretty close to those IRMA thresholds. If you've got some investments at a loss, you can rebalance those, create some capital losses. You'll at least get a deduction of $3,000 that will help reduce your adjusted gross income, modified adjusted gross income. So those are 3 strategies. What are some other ways to manage the impact or eliminate even the impact of IRMA in your financial life?
I had one come up just yesterday with a client. I was kind of teaching them the concept of a qualified charitable distribution. And if you've not heard of that before, it's essentially when you've reached age 70 and a half, you're into an age where you can now be drawing out of your IRA if you want to, and using it for whatever you want. And as we started to understand a little bit of their cash flow, we realized that, well, there are some important charities that they support every single year, one of them being their local church. And essentially what they were doing is this person's over age 72, so they have required minimum distributions. Every year they have to pull money out of the IRA. And last year she was kind of just writing checks for tithes and offerings at the church. You know, every month or every week or whatever, she was dropping money into the offering plate. Well, we explained to her that actually a better way to do that, at least financially, is to not take receipt of that money. Don't receive the money out of the IRA and then give it to the church. Instead, send it from the IRA directly to the church as a qualified charitable distribution. And what that means is you don't have to count it as income on your tax return at all. And by not counting that chunk of income, what if that made all the difference from one year to the next of whether your income creeps up past this threshold where IRMAA starts to apply?
And it's a little bit technical because you say, well, wait a minute, if I'm itemizing, I get to deduct that contribution. That's true, but you get to deduct that after your modified adjusted gross income is calculated. So it doesn't help you. You say, hey, I took $10,000 out of my IRA, and then I wrote a check to the church, and so therefore my modified adjusted gross income is $10,000 less. It's not. Now, if you're able to itemize, you can not pay federal taxes on that money, but you will pay state taxes on that money.
And you'll have to pay the IRMAA.
That's right.
I'm
That's
glad
the
you're
point.
bringing that up, Kevin. Yeah, absolutely.
So this is where because I always thought, all right, as I get older, I want it to be simple. Like, just make it doggone simple. Because you're like, okay, it's really simple. Guess what? You can start doing QCDs at 70 and a half. And you say, well, that's when I have to start taking money out of my IRA. It used to be, now it's 72, because 72 makes much more sense than 70 and a half. And they're talking about moving it to 75 because we have no idea. So, it's arbitrary. They have some sort of like Wheel of Fortune thing that they spin, and they're like, okay, well, here's the age that we're going to do this.
Trying to buy votes, and I'm in favor of that one. Give people more options. You might be listening to this saying, well, geez, I don't really have that choice. Well, financial planning so much is being proactive and planning ahead so you have more choices out there in the future. So qualified charitable distributions, last thing that I'd mention, we've talked about this quite a bit, is that money needs to go directly to the charity. It can't go to you from your IRA to you and then from you to the church or to the charity. It's got to go directly to them. And also, you can't do it from your 401k. You can't send money from your 401k to the church and have it be a qualified charitable distribution only from IRAs.
And there's some fancy footwork involved with that. It's so fancy I can't even say it. So what you want to be careful of, and we had some folks that were sending money to their church, and it's a Catholic church, and you're not going to believe this, but there was another Catholic church with the exact same name in Illinois that was getting the money. So they made the connection because they got this receipt. It wasn't a ton of money, but they got this receipt from this church in Illinois that said, "Hey, thanks for your gift." And they're like, "What are you talking about?"
Thanks for the gift. And who are you again?
Wow.
So I mean, whether it's Holy Family or and the Protestant side, a lot of those have this. I mean, there's more than one First Baptist Church. So you just need to make sure that money is getting to the right place.
Yeah, got it. All right, what are some other strategies? So this one isn't for everyone as well. And speaking of options, you might scoff at this one, but delaying your Social Security until 70. I mean that means you're not having that income show up on your tax return, and therefore your modified adjusted gross income is lower. Now you might say, well, if I'm delaying Social Security until 70. I've got to get income from somewhere. And so if that just means I'm taking the same amount out of my IRA, so therefore it's a net wash on your tax return, well, then be aware of that. But if there are other resources, if you have some non-IRA dollars, either cash in the bank or investments that could be sold that don't create a lot of tax or something like that, and that allows you to delay your Social Security, great news is that income won't show up on your return for those years, but the other is you're getting an increase on your Social Security every year that you delay, every month, really, that you delay.
I want to write a book about that. Delaying your Social Security until age 70 is one of the most powerful financial planning strategies that the mass affluent can choose. Because if you say, hey, I'm right on the bubble, I'm kind of prepared, not really prepared for retirement, but we're going to give it a shot. If you're working at a job that you like, because I was meeting with some clients this week, and he's 64, and he says, hey, I'm going to work until I'm 70, then I'm going to turn on Social Security. That financial plan it's not quite bomb-proof, but it's almost bulletproof.
Yeah.
Because the other reason why, because you might say, well, wait a minute, I've given up all those years. Why don't I just turn it on at full retirement age? Or why don't, how do I work through that decision? And the benefit in this case is there's a decent, if there's a decent age difference, then you say, hey, the higher Social Security amount is going to be received by the beneficiary.
Yeah.
So you say, even though I didn't get Social Security, because if I took it at age 70, this is the argument. I'd take it at 70 and die at 72. That's true, but your much younger beneficiary will get that amount until they die.
Mm-hmm. Yep. I love that you guys are putting this in the context of a retirement plan, though. The purpose of a retirement plan is to be thinking about the future. Do you have enough money to last as long as you need it to? That's the first question that most people have. Do I have enough? But then to take it to the next level, you would say, well, what is the income picture going to look like year on year throughout the rest of my life? And what you're saying, Mike, is, hey, what if you delayed Social Security for 5 years, which means your income is lower during that 5 years? You got to replace the income somewhere. Maybe it's with certain withdrawals out of various accounts and things like that. You're living off your assets. But a retirement projection looks at those types of details, if you're doing it right.
Yeah.
Right? And to take it one level even higher, then you kind of translate that into a tax picture that looks multi-year as well. Mm-hmm. Because each of those years is going to have a different tax consequence to it. And what you want to be looking at is, are there certain years out there in the future that maybe I'm at risk of jumping into IRMA, certain points? Is there something I could do differently? Could I change the nature or the pattern of my income to avoid IRMA in all the years? Or maybe the opposite. If I'm going to hit IRMA, let's hit it bad in one year and then avoid it all the other years or something. Maybe you take that approach. But this multi-year tax projection as part of a multi-year retirement forecast is one of the most powerful tools in your arsenal if you're working with a certified financial planner. And we have a client, actually a fan of the show. I think he's a fan. He's a listener of the show, at least.
Not all listeners are fans.
Yeah, that's right. No, he inherited some significant IRA dollars, and he's already been building a great nest egg of his own. And he's a business owner, a part owner in a business that will eventually get cashed out. And so there's a whole bunch of financial transactions that are going to be happening in the next 10 years. And he has been working with one of the stars here at KFG, Jared Moxness, who's not only a certified financial planner, but a CPA. It makes me jealous every time I say that. But he helped build one of these multi-year projections. And we realized, boy, there are some significantly painful years out there in the future if we don't take proactive action and actually start cashing in some of that IRA sooner rather than later that he had inherited from parents.
As geeky as it sounds, that multi-year tax projection is, again, I would argue, if you're on the cusp of retirement, you've got to look multi-year and project out what your income. You're deciding at that point, when are you going to draw Social Security? How will you supplement it from your investments? Should you be doing Roth conversions? And you're planning ahead. Well, is IRMA going to impact us? But you're also planning ahead to say, well, what tax bracket will we be in, and what adjustments could we make today to manage that? So,
yeah. And if you're just tuning in, IRMA is when you pay extra for your Medicare premiums.
Thanks for that public service announcement. If you one other strategy, I'm not sure if you guys have any with our remaining time here, but if you've got investments that are outside of tax shelters and you have a lot of capital gain in them. Qualified charitable distributions from your IRA applies to most people, but if you've got investments that have a very low cost basis, so a lot of gain, you could gift those. You could donate those. You could even gift those to kids if you wanted to. And does that help you avoid IRMA when doing that? No, there's no deduction, but at some point someone's going to have to sell that investment, and it wouldn't be you.
Right, and the folks that have an abundance upon, they're not going to get to it all in their lifetime. Those folks should not write checks out of their checkbook. Yeah. They should give highly appreciated stock.
That's right. Work with your certified financial planner on that. That's the big idea. Work with your CFP that's doing comprehensive financial planning, that's working with your CPA, or maybe is a CPA that's doing tax planning with you, and working with your health insurance expert. All right, that's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.